Bankrate published its weekly rate survey on July 22nd. The national average HELOC loan right now is at 7.43%. My margin rate on my M1 finance is at 5.65%. $11,321.77 is what I'm sitting on in my account back in that rate. People lump margin and a HELOC loan together like it's the same tool. Welcome back to another episode of Almost Wealthy. I'm John, turning my portfolio into my own bank on phase 2 of my bill stacking plan. It's not the same thing, and mixing them up costs people real money and real risks. Today, margin versus HELOC, side by side with the actual numbers and the actual trade-offs. Here's the thinking that leads people to lumping them together. Both are loans against something you already own, so at a surface level, they look interchangeable. Both let you spend without selling, both charge interest, but the assets are different. The process is different, and what happens when it goes wrong is different. Those differences are the whole point of this video. HELOC stands for Home Equity Loan Line of Credit. It's a loan against the value you built up in your house. The bank puts a lien on your house, a legal claim that sits behind your mortgage. To get one, you go through a full loan application, the same as a mortgage. A lender pulls your credit score. Most lenders want a score above 700 to get a decent rate. They also look at your debt to income ratio, how much you already owe compared to what you earn. Then they send an appraisal to your house to confirm what it's actually worth today. The underwriting reviews your income, your existing debt, your full financial picture before approving anything. The whole process usually takes 2 to 6 weeks from application to the funded line. And it isn't free. Closing costs on a HELOC can run anywhere from a few $100s to a few $1,000s. Once it's open, most HELOCs run on a 2-phase structure. First is the draw period, usually 10 years, where you can borrow, repay, and borrow again, paying interest only. After that comes the repayment period, often 20 years, where new draws stop and you start paying down the principal and the interest. That transition from interest only to full repayment is called payment shock, and it catches people off guard if they forget it's coming, which most of them do. The rate is normally variable, tied to the prime rate, and it moves whenever the feds move. Bank rate has the average sitting at a 7.43%, and Exprin has it at a 7.5%. That's the real cost of turning your house into a line of credit, the rate, the fees, and the structure. Margin works completely different. There's no house involved at all. The collateral is my brokerage portfolio, the stocks and the ETFs I already own. There's no loan application. There's no credit score pulled. There's no appraisal knocking on my door. There's no draw and no repayment period. It's just one ongoing balance for as long as I want it open. M1 looks at what my portfolio is worth right now and calculates how much I can safely borrow against it. That number updates automatically every trading day as my portfolio value moves. The money shows up in my broker tab, ready to use same day. No closing costs, no orientation fee, no minimum balance required to open it. My rate right now is 5.65% set by M1, ties to their own funding costs, not my credit score. That's the entire process. Portfolio value in, borrow limit out. Here's the part that actually matters more than the rate. Missed payments on a HELOC for long enough, and the bank can foreclose on your house. That's literally what the lien is for. Margin works different, and this is the part that people get wrong the most. If the portfolio value drops and my loan to value ratio, my LTV, crosses M1's call threshold, there's no house to take anywhere in this transaction. What happens instead is a margin call. M1 asks me to add cash or sell some of my portfolio to bring the LTV back down. If I don't act, they can sell my position for me automatically to protect the loan. That's called forced liquidation, not foreclosure. Different assets, different sequence, same core idea. Borrow against something you own, keep the loan to value safe. There's another difference nobody brings up in the comments. A HELOC shows up on the credit score as a revolving account, the same way a credit card does. Opening one involves a hard query, which can knock a few points off your score temporarily. Carrying a balance affects your credit score utilization and your debt to income ratio. That can hurt the odds of qualifying for a mortgage or a car loan down the road. Margin doesn't touch any of that. M1 doesn't report my borrowing balance to a credit bureau. It doesn't show up as a debt the next time a lender pulls my file. That's not automatically better. It just means margin sits completely outside the credit system, for better or worse. There are more basic problems with comparing these two loans as if anyone has both options. A HELOC requires equity. That means you already own the home and you either paid down enough of the mortgage or seen enough appreciation to have something to borrow against. If you're renting or you just bought with a small down payment, a HELOC isn't even available to you yet, no matter how good your credit score is. Margin only requires a funded brokerage account. That's achievable for a lot of people years before they even ever own a home. That part of why this comparison matters to me specifically because margin was available to me long before a HELOC ever would be. So when people tell me just get a HELOC loan, the honest answer is that plenty of people asking that question don't even have one yet. They don't even have one to get. So let's run the numbers. Say you borrow $720. That's the safe room for my phase 1 milestone unlock back at $6,000 in my portfolio. At my margin rate of 5.65%, the cost of $40.68 a year or $3.39 a month at the current average HELOC rate of 7.43%, that same $720 is $53.50 a year or $4.46 a month. The gap is $12.82 a year, about $1 difference a month on this small loan. Now scale it to $50,000, closer to a real HELOC draw someone might actually have. At 5.65% margin, $50,000 costs $2,825 a year or $235 a month. A HELOC at 7.43%, that same $50,000 is $3,715 a year or $309 a month. That's an $890 a year difference just in interest before you can count the appraisal fees, the credit pull, or the closing costs. That rate gap isn't even the biggest cost difference once you add all of that in. Why speed actually matters here. A HELOC takes 2 to 6 weeks from application to funded credit line. That's an appraisal being scheduled, an underwriter reviewing your file, closing paperwork, getting signed. My margin loan borrowing limit updates the same day my portfolio value changes. There's no waiting period between I want to borrow this or I can. For something like my phase 2 bills, $98 for the phone bills, $105 for my internet bills, $203 a month combined. That speed doesn't matter. Those are small, predictable, recurring costs I already planned for. But the speed matters a lot more if you're reacting to something time sensitive instead of something recurring. A HELOC is built for a slower, planned decision made months in advance. A margin is built for an instant one decided today. What happens in an actual downturn? This is something I don't want to skip because there is a risk to this. Miss a HELOC payment and the process to foreclose usually takes months, sometimes over a year, depending on your state. There are late notices, grace periods, and legal steps for the lender that has to go through first in order to process. A margin call moves at a completely different pace. If the market drops hard, my LTV crosses M1 threshold, that call can happen within days. There's no year-long legal process protecting the timeline. The portfolio itself is the only thing standing between me and a forced sale. That's why I don't run my LTV anywhere close to that 40% call line. I keep my target at 12% right now on purpose, specifically because I want distance before a bad month turns into a forced sale. A HELOC's slower failure process is a real advantage of this structure. Margin speed cuts both ways. It's why I can borrow instantly, and it's why I stay conservative with how much I want to borrow. The underwater risk with a HELOC. There's one more HELOC risk worth naming since I didn't have a margin equivalent. A HELOC is a second lien sitting behind your primary mortgage. If your home value drops enough that your mortgage plus your HELOC balance is worth more than the house itself, you're pretty much underwater. You can't sell your way out of that cleanly. You have to bring cash to closing just to clear the lien. Margin doesn't have a version of this problem. If the portfolio value drops, my LTV goes up and I deal with that directly. Sell some shares, add cash, or let M1 true it up for me. There's no scenario where I'm stuck holding an asset I legally cannot unload because the debt against it is bigger than what it's worth. That's a structural difference in how the two loans fail, not just a difference in how likely they are to fail. The trade-off that isn't in my favor. I want to be honest about where a HELOC actually wins. If you use a HELOC to buy, build, or improve your home, the interest can sometimes be tax deductible. Margin interest doesn't get the same treatment when you're using it to pay, phone bills or just bills in general. That's a real advantage for a HELOC in that right situation. A new kitchen model, a roof replacement, that's not irrelevant to what I'm doing since I'm not using my margin loans for home improvements. But if that's your situation, that deduction is worth running past a tax professional before you write it off on margin entirely. I'm not trying to make margin look perfect here. It isn't the better tool for everyday jobs. Why still pick margin? For what I'm actually doing, paying bills without selling my portfolio, margin wins on every point that matters to me. Lower rate right now, 5.65% versus a national HELOC average of 7.43%. No fees to open it, no appraisal, no 2 weeks of underwriting, no payment shock waiting for you decades later down the road, no minimum draw either. I can borrow $50 or $50,000 through the exact same borrowing tab. My portfolio going through a rough stretch is a math problem I can manage with an LTV discipline. My house going through a rough stretch is a much bigger problem with a much slower way out. What would change my answer? I'm not saying a HELOC is always the wrong move. If you need a much larger amount than your portfolio can safely support, a HELOC might be your only real option. If the money is going towards home improvements and the tax deduction actually applies to you, the math shifts in the HELOC's favor. And if you're not comfortable with the idea of a margin call selling your positions without warning, that's a legitimate reason to prefer a slower, more predictable process, even at a higher rate. Every one of those is real, valid reasons, just not my reason right now, not at my portfolio size. Run your own numbers before you assume either one is automatically the right call for you. To wrap this up, you have the same job, two completely different tools. A HELOC borrows against your house, margin borrows against your portfolio. Right now, margin costs less, moves faster, and doesn't touch a home at all. But it comes with its own risk. A market drop can trigger a call a lot faster than a missed mortgage payment triggers a foreclosure. Neither one is free money, and neither one is the villain some people online make it out to be. They're just two different levers attached to two different assets with two different failure modes. My situation, margin is a better fit. Your math might land somewhere else. Subscribe if you want to keep watching these comparisons with real numbers, and I will see you on the next one.